Hello traders, Gary Wagner here. It is Monday, the 4th day of September 2012, approximately 9:30 in Honolulu, 2:30 in New York, and this is the daily report for gold and silver. Little bit of resistance right around 1700 currently in gold as we look, currently trading up about $5 to $6 higher on the day. It is currently printing at 1698. Yes, traders. We have had a low of 87 and our high 1730. Silver, as you can currently see, it has broken solidly through $32, currently trading at a 32.35. It has a low of 31.84 and a high of 32.53. Traders, the first chart for today's show, weekly chart, Henkin format, continuous contract off the COMEX itself. A couple of things become quite apparent. We talked about this a little bit on Friday, but we're seeing the follow through that I like to see. Even though it is stalled at 1700, it really seems as though it's forming some kind of base. When we look at the Henkin Ashi charts, the one thing that we talked about was that unlike previous points when the market was trending solidly either up or down, really, we could best characterize the last couple of months in trading as highly defined in terms of alternating candle color, small body size. It tells you it's forming a base. We also talked about this triple bottom right in here with a series of lows that were not taken out. And when you think about the fact that this is our absolute high, 1920, right in that area, when it came down, and look at the time period, 1, 2, 3 weeks, really after the high, in 3 weeks it hit a low, and that low was never really taken out. It found support time and time again in this area. So that's the first thing. That support has absolutely held as we see this market moving up. But what we are noticing is as follows. When we take a look at the most current Henkin candles, for example, let me go ahead and blow that up. What you're going to see is that, first of all, we've got very, very nice body size. The bodies are growing. We've got a lack of these lower tails. That's very solid. And when we look at the moving average convergence divergence, that's right in here, you can see that no doubt they did cross. We talked about that a few weeks ago, but you can see that they're really splitting apart. In other words, rather than diverging and coming together, they are going apart. And convergence divergence is what we're looking for, whether or not those are widening or narrowing in terms of the actual MACD lines itself. Traders, once again, we're looking at a weekly chart. It's a different one. This has our Elliott wave count. It also has a couple of areas of Fibonacci retracement. We talked about the fact that we could possibly see some sort of resistance 1705 right in that area. And I draw your attention to where the market's kind of stalled, because it certainly seems as though we have a little bit of pressure in terms of there being some resistance here. Do I think that the market is going to come back down? Well, for certain, I don't know, but I can tell you this. My belief is that it will probably form some sort of a base in this area before moving higher. I don't really expect too much of a backlash, but I will tell you this, whereas in other times I have really gone to tighten the stops, my belief right now is if we get this continued strength in the market, I think the best bet is to look at these dips, these small little pauses, as very, very good entry points to add to our long position. The question remains, are we out of this fourth major wave? Have we entered our fifth major wave? Because traders, the key is, if we're actually heading into our fifth major wave, then we really want to start calculating and creating our strategy for how we can maximize some of the profits that we could in fact see if this market continues to run. And what I mean by that is we want to go back to some basic technical fundamentals. And those technical fundamentals are the basic tools I have been using over the last 3 years, specifically in gold, to plot where particular waves will go. Now, the best thing for us to say is I've already given you a broad stroke on where I think that this market could go in terms of long-term projections, meaning the conclusion or the completion of this major fifth. But traders, realize this. In a major fifth, we are going to still get an intermediate count of 1, 2, 3, 4, and then our fifth wave like that. What that means for us is that we want to be able to calculate with some degree of certainty and have some game plan based upon that particular model. Now, as I had pointed out in the past, the rule of thumb with your fifth wave is that it's normally about equal to the first wave. However, that's not the case when you look at the intermediate count. And what I'm talking about is this is our fifth wave here. This is our third wave. So let's seriously take a look at, just in terms of size, beginning of 2 to 3. And then let me go ahead and close that out. If we carry that forward, as you can see, there is no doubt, but traders, we are looking currently at a silver chart. This is the cash market, 420 minutes in terms of the size of the cycle. And in terms of where I think we'll find some resistance, I truly believe right now that this one line should hold as support. We're going to have to see. But let me go ahead and compress this chart just a little bit so you can have an idea, a better idea of where I'm pulling these numbers from. But what I'm looking at is this. When we take a look at the silver chart, I've done a basic Fibonacci retracement, and that's this last huge correction that we've saw in the market. It's also part of the triple bottom that's also in silver. We were able to identify a couple of key areas. And one of those key areas is the 61% at 33.14. My sentiment is for our interim upside target, we're going to have to determine whether or not we get some sort of a retracement here. And my sense is, looking at the short-term gold chart right now, that that's quite possible. Then, in fact, we want to plot where this market could actually retrace to, looking at this as a solid gain. And then from there, really what we want to look at, of course, is going to be retracement or correction levels for that. Now, one of the ways that we can do that is we're going to pull up this particular Fibonacci here, and what we're going to do is we're going to extend it to account for this top right in here. And then we want to look at different levels of resistance. Now, this is, of course, assuming that the market does, in fact, come down. Let me go ahead and plot this the right way. There we go. From the beginning, and assuming it has some sort of, call it resistance right now. I think it's going to follow gold, but we'll have to see. If we take a look at that, let me go ahead and line that up. What you'll probably see is this. In terms of a retracement level itself, the market has genuinely moved from 35 and change up beyond, or excuse me, very much above 26 and change to about 32. The logical area for us to look at is going to be either 28 or 38% levels. That being said, when we take a look at this dramatic rise here, and also you can see some activity right in here that's showing us potential support in the market, because as it came up and came back down, this is where it found support. I wouldn't be surprised for it to come back down and test roughly the $30 area, 30.50. This would be a wave 1, corrective wave 2. Then we would go into wave 3. And this, of course, is a minor count. It's not even our intermediate count. Now, why do I bring that up? When I look at the trading activity, this is our gold chart, and as you can see, it's 360 Henkin format. What we're noticing is this. When we take a look at the size of the candles as we go into the rally here, you see that they grow pretty nicely, but then they kind of stall and you get this consolidation. Following the consolidation, of course, you get this correction. Why is that important? Well, when we see this market go up, look at how solid these Henkin bars are. And now look at the fact that they are starting to get really pretty small, and we're trading at about $16.95. That tells me that there is the potential for that correction. Now, does that mean we'll see it? Well, absolutely not, because I can show you in many occasions. Let's go ahead and pick out a nice little run in here. And what you'll see is this. As a market moves up, you get a parabolic rise, but that's not the norm. This is a very, very strong rise in the market. And even with this rise, what you can see is it finds that bottom roughly 1520, makes it up to about 1620, consolidates, it forms a base. Then it heads higher. Small correction, higher, consolidation. Now, what I mean to show you is that when you look at the tops of even these markets here, or this time period, your candle size gets small, goes sideways, and then moves back up, as opposed to here getting small and correcting to a degree. And because of that, when you have gold run like this, you will get these periods where it consolidates, the range tightens itself, and it is in lieu of a correction, but nonetheless something powerful and that we need to really, really make note of. I'll tell you one thing, this week promises to be most interesting. This has been Gary Wagner, wishing you as always good trading. We'll talk to you tomorrow for another daily update and review. Bye-bye.